22 years without selling new stock, then 80 billion in 1 week. And buried inside that 80 billion, a $10 billion private order with two exact prices on the ticket, 351.81, 348.20. Now watch the buyer instead of the headline. 4.3 billion in the fall, 16.6 by spring on a filing signed by Mark Hamburg, then the 10 billion check wired straight to the company. Here is why that matters. Companies sitting on $250 billion do not usually pass the hat. And the most patient buyer alive does not usually pay top dollar. Both are printed on the same receipt. Tonight the board is in session. We learn to read it, number by number. The buyer is Warren Buffett, and when the whole market assumed a lieutenant made this bet, he closed that door himself, on camera. I initiated it. His call, his 10 billion. So the board reopens the file. Tonight we do the thing nobody covering this story will do. We rebuild the valuation Buffett must have seen, live, with the three numbers every valuation on earth comes down to. Growth, margin, the multiple. You can run all three at home. Then 5 legendary methods score the trade, and tonight every score comes with a condition, the one number that drove it and the trigger that flips it. One more thing, the company that took his money just posted the first negative cash quarter in its history. Hold that thought, stay with me. The board convened in July 2026. These are the numbers the legend saw. On the docket, the receipt, the machine behind it, the 3 inputs and 5 conditional verdicts. The scores stay sealed until each chair votes. The file is open. So what does Alphabet actually do for its money? Plain words, you type a question into Google and a business pays to be the answer. $63 billion of that in 1 quarter. You watch YouTube and an advertiser buys the pause before your video. 11 billion. And the newest business, other companies rent Google's computers, the same machines that run its own AI, that is cloud. 25 billion a quarter and growing faster than anything the company has ever built. Put together, $120 billion of revenue in 90 days, up 24%, the 12th straight quarter of double-digit growth. Sundar Pichai told investors the AI bets are, quote, lighting up every part of the business, but split the number and it is a 2-speed machine. Search grows 16, cloud grows 82. In one line, the ad network is shrinking. Remember that makes this a lesson and not a victory lap. Remember the receipt, 351.81 a share. The company cashing that check just reported free cash flow of negative $5.9 billion. First negative quarter of the entire AI build-out. And stock buybacks, 0, not reduce, 0. A company can grow 24% and still finish the quarter out of pocket. Buffett knows that better than anyone alive. He wired the 10 billion anyway. So tonight's question is not, is Google great? It is, what did he see? Input 1, growth. Do not take the 24%, split it the way the board will. Core search, 16.8, a mature giant. The ad network, minus 0.7, the one crack in the wall. And cloud, 82%, accelerating, up from 63 the quarter before, now a $99 billion run rate. When you pick your growth number, you are choosing which of those engines is the future. Buffett effectively bet on the fastest one. Input 2, margin. What survives of every dollar of sales? Operating margin, 34% up 2 points while spending exploded. The services side runs at 42, and cloud just flipped from 21 to 36 in a single year. But here is the trap that catches professionals. The headline says, profit tripled. Ignore it. 98 billion of that is a paper markup on stakes in other AI companies. Real underlying profit is roughly a third of the headline. Never value a company on its luckiest line. Input 3, the multiple. What the market charges you per dollar of profit? The trailing number on your screener says 17 times. It is lying to you. The paper gain inflated the E in the PE. The honest number is the forward multiple, 22 to 26 times, depending on the July day you looked. The S&P itself, about 25. Sit with that. An index average price tag on a company growing twice as fast as the index. That is the entire bull case in one sentence. Remember it. Now watch what happens when we run all 3 inputs at once. The owner's math, the way Buffett actually counts. Operating cash flow in the quarter, 39 billion. Data center spending, 45. Left over for the owner, minus 5.9 billion. The build-out bill more than doubled in a year. 91 billion to a $200 billion plan, and CFO Anat Ashkenazi says it rises again next year. So the company sold 80 billion in stock, borrowed tens of billions more, debt up 9 times in 18 months, and parked $250 billion in reserve. The bet is brutally simple. Cloud margins must turn that spending into owner's cash before the cushion runs out. And Buffett has told us his lens in his own words. The trick is to find businesses that earn high returns on capital for an extended period of time. He also confessed the sin. I made a mistake. His own Geeko spent years buying Google ads. He watched the machine print from the inside and did not act. He sold most of his Apple too soon by his own admission. This is the repentance trade. Late, huge, and at full price. And full price is the uncomfortable part. This was never a classic Buffett dip buy. The position was built while the stock ran from the 200s toward its all-time high, and the biggest single check, the $10 billion, was written at 348 and 351, near the top of the range, not the bottom. So either the most disciplined investor alive broke his own rules, or the three inputs told him it is still cheap. That is exactly what the board is for. 5 methods. 1 house rule tonight. No score without a number, and no verdict without a flip trigger. 5 published methods, run as models. The methods, never the men. Fisher on growth, Graham on price, Lynch on what you know, Munger on incentives, and the Buffett model itself, forced to score its own author, scores sealed. Chair 1, the Philip Fisher model. 15 questions with one obsession. Is the growth engine real, and how long is the road?
The Fisher screen finds the rarest pattern in giant companies: acceleration with expanding margins, cloud compounding at 82%, faster than the quarter before, while its margin climbs from 21 to 36. That is real operating leverage, not a discount-driven sugar high. And the runway question answers itself. Most of the world's computing has not moved yet, and the AI build-out is forcing the migration.
The Fisher score an 8, driving number 82. The flip the day cloud growth falls back through its own last quarter pace, 63%. The acceleration story is dead and the 8 goes with it. Next, the man with the calculator. This gets uncomfortable. Chair 2, the Benjamin Graham screen, pay demonstrably less than a business is worth so you can survive being wrong.
The screen strips one-time items first, which deletes the headline profit on site. What remains is a fine business at 22 to 26 times next year's earnings, with free cash flow negative and the company selling stock to fund the gap. The defensive rule wants roughly 15 times. At July's earnings path, that is a price in the 240s, not the 350s. There is no margin of safety at this price. There is faith.
The Graham score, a 4, driving number minus 5.9 billion. The cash. The flip is a price, near 15 times forward earnings, the 240s on July's numbers. The screen starts saying yes. Either the price comes down or the earnings grow up. 2 votes, already a war. The next chair does his research on your phone screen. Chair 3, the Peter Lynch method. Buy what you know, then ask the killer follow-up. Does the company get paid for the love?
Start with the doorstep test. You searched today. You watched YouTube today. You navigated with its maps on a phone running its software. No company on earth passes know what you own like this one, and it gets paid at every step. 12 straight quarters of double-digit growth says the love is monetized. The catch, the thing growing fastest, renting computers, is the one part the man on the street never sees.
The Lynch score, a 7. Driving number 12, straight quarters of double-digit growth. The flip the ad network line. It is the only line already shrinking. If that rot ever reaches core search, the doorstep test breaks. Now the twist. The next chair wants to talk about conviction, not Buffett's, the government's. Chair 4, the Charlie Munger model. Invert the question, find the incentive underneath, and tonight it reopens the file most bulls skip. Alphabet is a convicted monopolist, mid-appeal.
Invert it, what happens if they do not spend the $200 billion? They lose the next 20 years to the 2 rivals who kept building. So the spending is rational, an arms race where second place may be worthless, but respect the file. Judge Maida ruled the search monopoly illegal. Both sides are appealing the remedy, and Brussels already collected $5 billion. Regulation here is not a risk. It is a recurring cost line, and management raised its own spending guide mid-year, the classic overrun. Too easy to love, too hard to dismiss.
The Munger score, a 5. Dead center on purpose. Driving number, 98 billion of debt, 9 times more than 18 months ago. And the flip cuts both ways. The first quarter, the spending guide stops rising. This 5 becomes a 7. A forced sale of Chrome on appeal, and it becomes a 2. 1 chair left, and it has to score the man who built it. The last share. The Warren Buffett model. Moats, owner's earnings, decades not quarters. Tonight, the strangest assignment in this show's history. Grading its own author's $10 billion homework.
The moat is as wide as they come. The world's default question box, the data loop behind it, and a distribution grip even a federal judge could only loosen. But owner's earnings are negative this year, and the author himself ranks this business below at least 4 or 5 he already owns. And the model must note the entry price, $351.81, near the top of the range. A fortress bought at fortress prices, still digging its own moat deeper with the owner's cash.
The Buffett model score a 6. Driving number 351.81, the price on his own receipt. The flip, owner's earnings. The quarter free cash flow turns positive with the moat intact, this 6 climbs. If the buybacks are still at 0 deep into next year, the model quietly calls its own author impatient. 5 votes in. But before the tally, this board admits 2 outside witnesses. Same house rule. Name the number that flips you.
The one number I'd watch is trailing 12-month free cash flow after CapEx, because that tells us whether this AI build-out is a moat or just a furnace. If Alphabet is back above $50 billion of TTM free cash flow by the end of 2027, I'd flip bullish on Buffett's $350 entry. If it is still below 0, then I'd call the trade a mistake.
The one number for me is the cloud operating margin, because it's the most direct signal that this historic capital investment is generating truly profitable scale. If that margin falls back below 30%, it would suggest the fundamental economics of this AI build-out are broken, and my own positive assessment of this trade would immediately flip.
Before the tally, my number. Not advice. My homework. I watch one line, the spending guide, 195 to 205 billion, and it has already been raised once mid-year. The first quarter that number stops rising, every score you just heard gets rerun, including mine. That is the tripwire I set for my own money. The board score 6.0 out of 10, Fisher 8, Lynch 7, Munger 5, Graham 4, and the Buffett model on its own author 6, the spread 4 to 8. See, here is the verdict in plain words, conditions attached. At July's prices, the methods call Alphabet a genuinely great business at a full price, carried by one bet that cloud margins turn 200 billion of spending into owner's cash before the cushion clock runs out. If the spending guide keeps rising and the cash stays negative, Graham wins this file. If cloud holds its pace and the cash turns, Buffett saw it early. Again, anyone selling you certainty tonight is selling you something. Your turn, and you have everything the board had. Input 1, growth, the blend is 24, the honest range runs from shrinking to 82. Input 2, margin 34, and never the headline. Input 3, the multiple, 22 to 26 forward. Pick your 3, score it 0 to 10, and put your number in the comments. That is the whole game. That is why we keep a playbook. The board saw July 2026 numbers. The numbers will age. The 3 inputs never do. Rerun this class on any quarter you like, on any company you like. That is the point of a playbook. So which chair got it wrong? The 8, the 4, or the 6, the model handed its own author? Put your score in the comments, and if this file showed you what the headlines would not, subscribe. The board sits on this channel. Next file on the board's desk, Apple. A retiring chief executive's final earnings call and a warning he named after a 100-year flood. The board convenes. Be in the room. For the record, tonight's 5 voices are AI models built from these investors' published principles, plus 2 live AI witnesses speaking as themselves. Not the men, not their words, not affiliated, not endorsed. Nothing tonight is investment advice. The board scores businesses, never your portfolio. Buffett's 10 billion, filed with conditions. The stamp is already inked for Apple's file. When the board convenes, be in the room.